Hey there, everybody. Welcome back to another 21st Century Renaissance and another open interest newsletter breakdown on GameStop. Once again, I am your host, Dr. Michael LoPiano, and we are back after a slightly longer hiatus than expected. Certainly appreciate everyone's patience with respect to some of my some family health issues there, which thankfully have resolved for for the better. So back to normal on those fronts. And then, of course, right, last week was my, a week ago Sunday was my wedding. So I am now Mr. Dr. Mojo to many of you out there. But just wanted to say thank you, of course, to everyone who sent along prayers, intentions for my father's health, as well as as always, well wishes. So much, right? We're gonna start right off here with our right. We always start with our generosity before, or gratitude for generosity before hopping into our discussion of GameStop. And I just wanted to say many thanks out there to so many of you who went ahead and sent along wedding gifts. That was so kind of you, as well as, of course, to everyone who has continued to support the channel. I just wanted to say before getting started, before getting back here, I'm really excited to get back to work here, to get back to writing, studying, analyzing, trying to understand what's going on here with the GameStop picture, but as well, so much that I'm feeling very inspired to get to work with as far as live streams. I have some ideas for some new content that I hope to be putting together for you guys in the coming year, especially revival of the 21st Century Renaissance podcast. So have some guests lined up for that hopefully we'll be able to share with you guys. But more on that to come. We will be back to our regular schedule for live streams this week at 4 p.m. Eastern time on Friday after market close. So let's go ahead and get into today's breakdown as we think about what's going on this week with GameStop and the broader market. Let's get to a little different picture. There we go. That's what I want there. So some additional gratitude for this specific newsletter, as usual, right, goes out to Prince Jackson for sponsoring today's video breakdown, as well as newsletter, including our monthly supporters, Not Medical Advice, Master Kurt Lesko, Cosmotropic to Swag 52, and Hey Luckies, aka Faithless Suitor, for contributing on a monthly basis to our efforts here at 21st Century Renaissance. My thanks as well to everybody who, like I said, has contributed, even if it's just with well wishes, intentions, prayers, questions, always super helpful, help me with my research and publication efforts. So thank you very much. Look forward to seeing everybody interacting once again with all you guys live, be it over on Twitter or at our live streams on Friday. Very much looking forward to seeing you guys. So let's talk a bit. I want to start a little bit more broadly, sort of as a recap, a little bit of what we've been looking at over the past couple of weeks. Obviously, I haven't stayed, been able to devote the type of attention that would require, say, a publication, but have been keeping my eye on things. And sort of, sometimes it's very interesting, I suppose, to kind of go out and say, if you take a 2-week period to look back on things that you said, okay, well, I wrote about this 2 weeks ago. Without, say, adding anything or seeing any additional signals, how does stuff end up playing out? And in this particular case, it was very interesting to see this bearish PMO cross that I talked about back right before the hiatus, I think around the 20th or the 21st of July, came to fruition in terms of the return of some volatility. So not terribly huge, pretty standard for that kind of bullish trend, a bearish correction within a bullish trend for SPY. But we did see a bit of that. We have recovered a bit, but of course that hasn't changed the fact that it does look like we are going into something of a more bearish correction pattern. So I wouldn't be surprised if we don't kind of immediately go right back up out of that, but take a few weeks or maybe even a month to kind of get back to something a bit more bullish, maybe towards the end of the year, right? So do we have a correction sort of now into September ahead of anticipating FOMC rate cuts? So we did not end up getting that rate cut on July 30th. What that means for us now, if we go ahead and take a look at our FedWatch tool, is let me just hit a quick refresh, make sure those percentages are stable there. They should be. I did refresh this earlier today. Is this right? Oh, wow. Yeah. Wow. Actually, no, that really changed. There is now a 90% probability that we will have a rate cut for September 17th. So Fed has not changed. That changed very quickly, actually. I am very curious. I'll have to look at this. Maybe we can come step back into this on Friday at our live stream. But really interesting to see this, right? See this pop up. It wasn't around, was it 39, right? But it does seem though potentially Fed forward guidance has shifted confidence of that rate cut, a 25 basis point rate cut for September 17th at 90% now. So that's quite tremendous. And usually what that means when we do get a rate cut is that tends to be bullish for equities. We'll see what that'll mean, right? So right now, what we might be seeing is derivative repositioning. So this was the case. I did mention this in today's write-up. We are today at the 1-year anniversary of the 2024 Nikkei crash. Supposedly Nikkei crash, right? This flash crash event over in Japan that supposedly had implications for the yen carry trade. To what degree that is what drove the price action that we saw in the American markets, not sure, but I would certainly, I could easily buy, right, in some way, shape, or form, derivative repositioning, institutional derivative repositioning, which requires very large, very complicated, multi-layered hedging rebalancing with respect to those derivatives. Seeing that, of course, take place a year ago, and then how much of that volatility or potential issues were packaged away into 1-year total return swaps that then some derivative repositioning needed to occur, hedging repositioning needed to occur, basically going into yesterday or today's trading, that 1 year anniversary. Very interesting to see now that the rate cut estimation is down, right? This may be then positioning basically into the next 4 or 5 weeks now to account for that. You'll recall, right, of course, with GameStop, this is very good news for GameStop if we do end up getting these 3 rate cuts. What this will mean, right, what seems to have been the case last year, if we bump over to our GameStop chart here, what really seems to have driven some of our biggest volatility moments, that is bullish volatility in GameStop, it seems to be that these were correlated very highly with with reactions to FOMC rate cuts. So, for example, we had Fed meeting on Wednesday the 18th. On Friday, GameStop absolutely ripped, and that is how that third at the market offering appears to have been bought up. We had the rip in, right? So we had our cat day thing, but then we had, let's see, the move out of, so the second wave of this, we had FOMC on the 7th. So a Thursday, and then this ended up being a multi-day rip here that then culminated toward the end of the month. And then, of course, we stayed high, but came right December 18th, right here. We also had FOMC, and that resulted in the move from sort of a 28-ish up to about 35 in that run. So this run in the fall seemed very highly correlated with, or very potentially connected, reasonably connected with FOMC rate cuts. So if we do get another round of this, which does seem to be the case, we could anticipate another cycle of this type. If that's the case, I would not be surprised to see institutions do as they did essentially last year, which is, right, we moved into this a couple different low volatility periods, which they then exploited, right? If we take a look at this, we can see this type of pattern, this daily pattern going into the rate cut, actually going into National Cat Day. Very similar to this kind of waveform, low volatility move that we've seen here in GameStop over the past couple days. So when I see this type of move that says, okay, institutions are positioning here, they're getting ready. We have institutional filing deadline coming up on, I think it is the 15th. It's 45 days from the end of the quarter. I think that's going to end up being the 15th. So we have seen some over on Quiver Quant, our friends here showing us, we are starting to see some stuff come in. but this is largely small potatoes. This is retirement investments. This is pension funds. Mostly bullish for as much as that matters, but we're looking at pretty tiny stuff. I mean, I think probably the average ape here, right? The average GME hodler is probably tossing around shares in kind of increments like this, right? At bigger portfolios than maybe some of these retirement investment managers have. So yeah, I think it's the 15th because June 30th I think was the end of the quarter there, end of the previous quarter. So another few days we should start see this coming in. But if that whatever the case is, this may then, as these positions are revealed, correlate to either stimulate or signal that it is okay to go bullish on GME, something to keep an eye out for. To see that, right, then see how that might potentially combine both with, let's say, optimism and reasonably placed optimism, I would say, going into quarter two earnings. So earnings is projected to be to have operational profitability. Let's see real quick. I outlined this here. Looking at operational profitability, we're looking at Switch 2 sales, expansion for PSA. We've got Push Start Arcade launching. Guys, Push Start Arcade launched. Guys, remember we were talking about this on the live streams. We did this. We talked about this all the way back in February. Remember the Thailand times? Remember the Thailand live streams? We had, how many of these do we have? We talked about basically the concept, right? We talked about, we can even go over this again. It's probably worth it at next live stream about what the implications of this mean. We can reflect the tokenization, the PSA partnership theory, kind of reflect on that. That actually makes a really good topic for this week's live stream. Let's do that this week. Thinking about the implications of GameStop essentially partnering with PSA, building this marketplace, this digital marketplace, tokenizing cards, right? Tokenizing trading cards and collectibles of various categories, right? Of various classifications through the PSA vault system, and then facilitating the exchange of these, drastically lowering the, let's say, market entry costs and freeing up a lot of frozen capital that's contained in these otherwise less liquid assets, right? By making these assets tokenizable and therefore extremely liquid and accessible. So very interesting to see how all of that is going to shake out on Q2. Obviously, Push Start Arcade, not quite. There's not going to be too much in terms of revenue for that, but obviously, right, that's going to interesting to consider as a part of the PSA expansion, something for us to talk about. But then, of course, there's going to be sizable investment returns, both with respect to BTC appreciation and just taking that extra, $4 billion from the last convertible bond offering and just enjoying the 100 or so million in 3-month treasury returns off of just kind of plowing that into something stable as an investment and predictable. So very interesting to see that is likely going to be received well in terms of what that'll look like. We're already seeing in terms of IV, it does look like something of an IV appreciation, right? Even though we've looked at GameStop's price across the sort of late June to early August window trend down, we are seeing IV recover. So we're back up to these kind of more reasonable lows. It's still low, but it's not in the 50s, which was absolutely ridiculous. That was insane to see those levels. Those are 5-year lows. We're back to what would be something like a 1-year low previous to this deep low there. So out of the 5-year low territory into the 1-year low territory. But I would not be surprised to see, a move like this if we look back to last September, right? We kind of bottomed slightly above the kind of 80-ish range composite in August. Following the Nikkei crash, we kind of bottomed in late August. And then around the 30th, I think we started to charge hard back to the upside for 2 weeks. We did see what was likely some, issues, things that needed to be settled or cleared from the summer, possibly being cleared heading into Q2 earnings. Before then, we settled back down again. So maybe we'll get a little excitement kind of heading into the second half of August there. That being said, in terms of settlement stuff, right, we probably do have to keep an eye on, thinking about what the next few weeks, right, thinking about what this is going to mean for GameStop. If we're looking at a 90% likelihood that we're getting a rate cut on September 17th, that's likely going to be bullish for GameStop. GameStop, as we pointed out, did respond bullishly to those rate cuts, those 3 rate cuts last year. Something similar may occur this year. Q2 is going to be bullish, probably not going to be heavily sold. I mean, I guess it depends what we're going to do going into those first couple weeks prior to the Q2 earnings report. This may be right here, right prior to OPEX, an opportunity for institutions to go ahead and clear out some of this, let's say, internalized volatility, say going back to the offering in June, going back to the offering in April. If any of this has been sort of can-kicked, messed around with ETFs, internalized, kept trapped, not settled, if it's been sitting in the obligations warehouse, something like that, there may be some incentive to go ahead and clear this stuff now before major institutions go ahead and reveal their positions heading into August OPEX, before, say, waves of potential bullishness price up those obligations and make them rather untenable for institutions that do have to go ahead and clear those ahead of possibly an unfavorable recaps date. So some potential volatility may be coming up in there. Why am I thinking about that? I'm thinking about that because that's influencing my willingness to go ahead and put out my typical short volatility trade. So right amid all of this, amid the hiatus, you guys know we've talked about this on the live stream. I've been making a lot of short volatility trades. That's been my bread and butter this summer, while waiting, essentially anticipating that we're going to have this kind of dead period, low volatility period, and using this in order to continue to grow and accumulate my position in GameStop. Little hesitant about entering into those types of trades given where we are in terms of our price range. And these possible upper, let's say, more upwardly volatile price action events that may be coming in over the next several weeks. So, not saying that this is definite, of course, but taking this into account and looking for some potential signals that may, influence my decisions one way or another. Obviously, we can always talk about this more during this week's live stream. If we take a look at our options data this week, still largely neutral. We do see quite a lot of call activity, and saw some yesterday on what looked to be initially in the first part of the day something like a VWAP that then sort of stopped, but then got bought right back up, possibly via interference from a sizable amount of lending liquidity. GME lending liquidity all of a sudden started getting very interesting. If we go over and look at cost to borrow, we can see that, somehow we're seeing really unprecedented levels of available shares to borrow in Interactive Brokers, at least per the data reported by Interactive Brokers, up 10 million. I mean, that's close to double the max that we saw going into the second bond offering. Prior to second bond offering, had not seen anything above like 5.4. We did see a little bit post bond offering. I think that was around 6.3. And now we're at 10 million. So sometime during the trading day, on Friday, right? Last Friday, we were at 5.2. Over the weekend, got up to 8.8. And then shortly before trading, is that correct? Wait, no, that was very early in the day. We actually got up to 10 million intraday. To begin the day today, we were at 8 million, or yesterday, excuse me, went back up to 10 million. And it doesn't look too clearly that, at least from this regard, that maybe shorting was responsible for some of that price positioning. In any case, it does look like that we are starting to see some of that potential price recovery off of those lows we saw last week. And there does look to be some call activity in possible response to that recovery. What I will say is that only at one strike or so does that appear to be skewed toward the ask for now. So not quite sending signals of too much excitement for some upward volatility. Doesn't mean we won't get that. Put side's incredibly quiet over on the put side. Most activity is over on the call side. So what I would say is interesting in that regard, however, is how the 23 position has developed. So we do have Max Payne going out for several weeks now, is pretty well stuck there at 23. But if we look at our gamma data, right, you'll recall that, say, for most of July or the end of June, we were really looking at 24.25 as that kind of area of resistance, given the accumulated call GEX there. 23 has stepped out as a major call GEX accumulation point in its own right, expanding that call GEX dominant range to about that 23 to 25 dollar area. Now, what that means is if we do get into that area, it does suggest volatility suppression and largely stable trading in this range, say between 23 and 24. And if we go above 24, 24, 25, by the influence of normal options trading activity. However, if we do get institutions that decide, okay, we are going to go ahead and clear some of this internalized volume, we are going to take care of some of these obligations before August OPEX, before institutional filing deadline, before we get into this 1, 2, 3, 4 of major events, culminating with what is expected to be this first major rate cut on December 17th, that we're just gonna de-internalize this stuff and deal with it. That type of event may end up churning up quite a lot of volatility, which will then churn up some hedging and quite a lot of institutional buying with respect to these call positions. So something to keep an eye on there. Something that could result, especially as we move later in the week, to some dynamic play in terms of institutions that may drop a fair amount of lit volume where possible, lit market volume where possible, to try to actually take advantage of some of these dynamics and this setup of major, increasingly call biased options positions between 23 and 25. You recall, especially last year around this time, we did see this type of setup that resulted in quite a lot of fun times on Fridays in terms of being able to play with some volatility. So keeping an eye on that. Obviously, right now, still kind of looking out for something that's a little bit more decisive one way or the other. I'm still kind of cautious, trying to get a sense of our shape maybe going into the next couple weeks and what the character of trading is going to be. Keeping an eye on this current, what seems to be something of a recovery bent in the context of what we're seeing, say, broader market wise, wide. No, wise, I said that correctly. Yeah, just keeping my eye out otherwise for any additional news in terms of what to expect. Going into what should be a pretty interesting season for the company here from, let's say, August 15th out into September 17th. So going to be an interesting, I would say the September OPEX period is going to be very interesting. I think September OPEX is right after the 17th. I think it's the 19th this year. So something to keep our eye on. That's it for me today. Very happy to be back once again. Very thankful to all the support you guys have given, not only recently, but also over the past year plus of this GameStop journey. Over on Reddit, on X, and of course here on YouTube. So very thankful for all of you. I'm extremely motivated, right, to continue doing this work, doing this, putting out this content, doing the best I can to help others learn, to help you guys learn, and to help myself continue to gain a better idea of what's going on here with as far as I'm concerned, the number one stonk in the world. So very much looking forward to seeing you guys going forward. Looking forward to continuing this second full year of 21st Century Renaissance and open interest here on GameStop. Looking forward to seeing you guys as well this Friday, 4 p.m. Eastern time. Once again, we'll have our live stream back, and it's future's looking bright. I'll say that. Thank you very much, guys. We'll see you next time. Take care.